Hello and welcome everyone. Today we're going to talk about investments, diversification. The importance of diversification in investments. If you're new to investing, or just looking to improve your portfolio, then this video is for you. Diversification is a key concept in investing. It's the idea of spreading your investments across a variety of different asset classes and sectors, rather than putting all your eggs in one basket. There are a few key reasons why diversification is so important. First and foremost, diversification helps to reduce risk. By investing in a diverse range of assets, you're not relying on any single investment to perform well. This means that if one investment underperforms, the overall impact on your portfolio will be minimized. For example, let's say you have a portfolio that is heavily invested in a single company's stock. If that company experiences financial difficulties, such as declining sales or a lawsuit, your portfolio would likely suffer as a result. On the other hand, if you had diversified your portfolio to include a mix of stocks, bonds, and other assets, the impact of any one investment underperforming would be much less significant. Diversification also helps to improve returns. While it's true that any individual investment has the potential to earn a high return, the reality is that not all investments perform equally well. By diversifying your portfolio, you're giving yourself the opportunity to earn higher overall returns by capturing the gains of multiple investments. For example, let's say you have a portfolio that includes stocks, bonds, and real estate. If the stock market is performing poorly, the bond and real estate portions of your portfolio may still be doing well, helping to offset any losses in the stock market. This is because different asset classes can perform differently in different market conditions. Stocks tend to do well in times of economic growth, while bonds tend to perform better when the economy is slowing down. By including both in your portfolio, you can potentially capture the benefits of both. In addition to reducing risk and improving returns, diversification can also help to smooth out the ups and downs of the market. Instead of experiencing large swings in the value of your portfolio, diversification can help to even out the highs and lows, providing a more stable return over time. But diversification is not just about choosing different types of investments. It's also about finding the right balance between those investments. For example, if you have a portfolio that is heavily weighted towards stocks, it may be more volatile than a portfolio with a mix of stocks and bonds. On the other hand, a portfolio with too much in bonds may not provide the potential for growth that a stock-heavy portfolio offers. So, how do you go about diversifying your portfolio? There are a few key strategies you can use. One option is to invest in a variety of different asset classes, such as stocks, bonds, and real estate. Each of these asset classes has its own unique set of risks and returns, and by including a mix of them in your portfolio, you can achieve a more diversified investment strategy. Stocks, for example, are a type of investment that represents ownership in a company. They are typically considered to be riskier than bonds, but also have the potential for higher returns. When you own a stock, you become a shareholder in the company and are entitled to a share of the company's profits. There are different types of stocks, including common stocks and preferred stocks. Common stocks represent ownership in a company and give shareholders the right to vote on company matters. Preferred stocks, on the other hand, do not give shareholders the right to vote, but they do typically have a fixed dividend and a higher claim on assets and earnings than common stocks. Bonds, meanwhile, are a type of investment in which an investor loans money to a government or corporation in exchange for interest payments and the return of principal at a later date. They are generally considered to be less risky than stocks, but also have the potential for lower returns. When you buy a bond, you are essentially lending money to the issuer in exchange for regular interest payments and the return of your principal at a specified date in the future. There are different types of bonds, including government bonds, corporate bonds, and municipal bonds. Government bonds are issued by national governments and are considered to be among the safest investments. Corporate bonds are issued by companies and carry a higher level of risk than government bonds, but also have the potential for higher returns. Municipal bonds, also known as munis, are issued by local governments and are typically tax-free, making them attractive to investors in higher tax brackets. Real estate, meanwhile, is a physical asset that can be purchased and owned, such as a rental property or a commercial building. It can be a more stable investment compared to stocks, but also has the potential for longer-term appreciation. When you invest in real estate, you can either buy a property outright and hold it as an investment, or you can invest in a real estate investment trust, REIT, which is a company that owns and manages a portfolio of real estate assets. Another option for diversification is to invest in a variety of sectors within a particular asset class. For example, if you're investing in stocks, you might consider including a mix of companies in different industries, such as technology, healthcare, and finance. This can help to diversify the risks within your portfolio. Different industries tend to perform differently in different market conditions, so by including a mix of industries in your portfolio, you can potentially capture the benefits of those that are performing well. For example, if the technology sector is doing well, but the healthcare sector is struggling, a diversified portfolio that includes both sectors may still be able to earn good returns. Finally, you can also consider investing in a variety of geographies. This could involve investing in companies based in different countries, or investing in real estate in different regions. By doing this, you can diversify your portfolio across different economic environments and currencies. For example, if you invest in companies based in different countries, you can potentially benefit from economic growth in those countries. Similarly, if you invest in real estate in different regions, you can potentially benefit from regional economic trends. It's also important to remember that diversification is not a one-time event. As your financial situation and investment goals change over time, it may be necessary to adjust the diversification of your portfolio to ensure it continues to meet your needs. This might involve selling some investments and buying others, or simply reallocating your portfolio to different asset classes or sectors. In conclusion, diversification is a crucial concept in investing. It helps to reduce risk, improve returns, and smooth out the ups and downs of the market. By taking the time to diversify your portfolio, you can increase your chances of long-term success in investing. Thank you for watching this video on the importance of diversification in investments. I hope you found it helpful, and that you'll consider diversifying your portfolio as part of your overall investment strategy. Thanks for watching.